Well, South African banks have experienced strong momentum on lending in 2011, yet a forecast slowdown in the economy may change the lending landscape. Coupled with new regulations from the Eurozone banking crisis, the future of South African banking perhaps clouded. Joining us for more is João Schwarz, who is a partner at Bain & Company in London, and also joining the discussion is Byron Lotter, portfolio manager at Vestact. João, let's welcome to the studio. I think it's the first time you've been in. Let's look firstly at, just to perhaps have a look at the global scene and the Eurozone particularly. We see France, before we talk about South African banking, France double-dip recession, second in 4 years. The Bank of England, though, talks about revising its growth forecast 1% up, so they're looking quite cheerful. As the Bank of England governor goes out, he says recovery is in sight. So perhaps let's just look at your overall assessment of the Eurozone at the moment before we go on to the banks.
Sure, happy to, and thanks for inviting me. The perspectives for the Eurozone are still bleak in our opinion. What we're seeing is a continued deterioration. It's a sort of vicious cycle that both the banks and the governments are going through in terms of their levels of debt. And so as they continue to push austerity as a single measure, what we're seeing is that austerity is not enough as a measure to solve and to break this vicious cycle. And we're continuing to see both countries deteriorate their debt position and the individuals and the corporations also increasing their debt positions compared to what they generate in terms of income. And for as long as there's more debt growth than GDP or wealth growth, the situation continues to deteriorate. And for the last 4 years, that's been happening in Europe, country after country after country.
Byron?
Yeah, we've seen a 10% growth in European stocks since April. There's obviously still an extremely huge amount of wealth in Europe. When we start seeing asset prices pick up and possibly in the property market as well, do you think the wealth effect will come through and people are feeling a bit more confident and then maybe consuming a bit more?
That's a very good question. We're seeing that generation of wealth is not the same or consistent across countries. So there are countries that their wealth exists, like Italy, and it's being purely depleted in the periphery countries such as Spain or Portugal or Greece. And so there is no incentive for the increase in consumption in these nations. Where you see it is in the countries like Germany or Italy, which are still hesitating on which path to take, but the path forward is still not clear.
What about Britain and the governor saying recovery in sight?
Well, it's an optimistic view considering the links between the Eurozone and Britain. And so there are a number of signs which are positive in terms of growth, etc. But there is no sustained case across the entire trading region and partners to justify the optimism as of now or as of yet.
Yeah. Let's look at the banking sector, and you've put out a recent presentation on South Africa retail banking and the Basel III implications for that. And I think a lot of people glaze over a little bit when they start hearing capital adequacy ratios and tier 3 and this sort of thing. So one wants to need to explain to people why this is so important. But I think perhaps in your executive summary, and maybe we could start with that point you make, you talk about the major banks should meet the Basel III capital requirements, no problem there, but they lag behind when it comes to liquidity. So why is this important?
Well, the liquidity elements are key integral factors on how the banks will be positioned in the future, both for system and for individual banks. How did the problems in Europe came about for a number of countries like Ireland and Spain, who started with levels of public debt as a percentage of GDP very similar to what South Africa has today. So they were 40% or below. And still, those countries did get into trouble and they did get dragged into a crisis. So the relevance is on the banking side. So those countries were dragged because there had been real estate bubbles which had been financed by the banks, and those banks did not meet or comply with the new stringent regulations or the regulations that now exist to make sure that the banking sectors do not fall into the levels of distress that we've seen in Ireland or in Spain. That's why it's relevant to make sure that while the times are good, the banks are able to meet those solvency and liquidity requirements.
Byron, this is a subject you've been taking an interest in.
Yeah, I'm not sure if you look at the micro lending environment at all in South Africa, but we've picked up a trend due to the heavy regulations coming through from Basel III that the banks are more inclined to go into the unsecured market rather than the collateralized lending. What do you see, or how do you see that, and how do you see the South African micro lending environment?
What we see is that it's a question of mix. So the major area of problems is when we've gone in Europe to areas of to excessive lending to a specific sector. When we became almost monolines, for instance, when you business lending as a percentage of total lending of a bank exceeded 70%, that presented risks because as the economy starts contracting, austerity gets introduced, consumption comes down, and often by 25% or more, like the case of Ireland, and that drags the SMEs into bankruptcy. Unemployment rises, and those people can't pay back, be it the corporations or the unemployed. That increases the NPL level, the non-performing loan level, and that creates solvency issues, and that requires more capital, etc. So it's that cycle that we're trying to break by having the regulations brought in up front on the process.
We're going to bring in Gary Boyson from Vunani Private Clients here. And Gary, perhaps just to take the discussion to the South African market and the companies that we have, and then back to the unsecured lending space, because yesterday we had SPAR results were out, and a comment by Wayne Hook, the chief executive, he said people are there's less credit being extended. So I said to him, well, partly that problem is that people are borrowing to buy food from SPAR and other retailers. So that's an issue, and it's unsustainable. But on the other hand, it's that there's less disposable income because there's less credit. So it's not necessarily that they're buying on credit at SPAR, but there's just less money around. So that's, and we've heard from African Bank that upset the market when they put out their results and down by more than people expected. Capitec, which has been the star of the show, has warned as well. Where are we with that? And is it as dangerous as it may seem to some?
Yeah, I think, if you look at sort of retail sales numbers, we saw if you really break into those numbers, you saw furniture slowing down quite a bit, which if you look at African Bank, a lot of their lending has gone to literally, finance consumption purchases. Guys were, taking unsecured credit because it's all they can get hold of, and then going and buying couches and all that. Now, obviously, with African Bank, sort of pulling back on the lending, you're seeing, that consumer under pressure, and you're seeing that feed through in the retail sales numbers as well. Strangely, hardware and jewelry and the likes, and the high LSM sort of products still doing very, very well in the retail sales. Even though, the story, the retail sales number yesterday, it's a notoriously volatile number, so it is going to be all over the place, and it wasn't quite as bad as we had expected. I think the tone for the consumer this year is definitely going to be one of a weaker consumer in South Africa.
Yeah, John Luce was saying last night that you've got to look at the smoothed average of that, but it still doesn't look good for future sales. Now, Joao, you say in your presentation, we don't anticipate an unsecured lending bubble. Now, you've obviously done a great deal of work here, so that's reassuring because there are people who say there is an unsecured, but you say concentration risk exists in lower SMEs. What's concentration risk?
Well, it's a question of, as I was mentioning before, how much lending are you giving in terms of your balance sheet exposure to sectors of the economy, specific sectors of the economy. And SMEs are usually the second wave of trouble. The first large wave of trouble is usually commercial property. When there is a slowdown, that's the first to be hit. And so if you're very exposed to that one, to that segment, you will suffer disproportionately. The second one is the SMEs, and that's if you have a high concentration risk, it's a very hard hurdle to overcome. When the consumption goes down and the SMEs go bankrupt, that is usually a large chunk of the lending of the banking system. And the third one will be mortgages. So, and they always work in these three waves. The unsecured runs parallel. And so if you're a monoliner on unsecured lending, you're likely to be one of the first ones to face trouble. And on Gary's point, that what we're seeing is an issue of the reduced disposable income. That does create an additional pressure onto the banking system. If you do have a lower disposable income, that, comparing to house prices, will create a bigger gap. That tends to generate bubbles, which was what happened in Ireland, what happened in Spain, what happened in Cyprus. And the only way of solving it is either restore growth and restore the disposable income, or have to mark down the prices of the collateral or the houses or the secured lending that you have on your balance sheet.
And just to throw in there the amazing number that I saw the other day, and a couple of people on our discussion panel that morning didn't believe that 94% of South Africans do not have collateral, home loan. Now, I don't know if that's the entire population, including children who wouldn't qualify anyway, but it's still very high, and I'm not sure what the percentage is elsewhere, but we do have historically a very low home loan exposure. And the point that was being made was that's why unsecured lending is so important. It was actually Mark Lamberti from Transaction Capital. He said that's why it's so important, because that's the only access that people have to credit.
Well, if there's no collateral to be given in any economy, then the growth of the banking system will be on the unsecured, which increases its level of risk.
Of course.
So it's a question of how the banks provision for it and how much they have in liquidity to withstand shocks.
Yeah.
And so when we looked at the results being published by the South African banks, they were starting to have an increase of cost of risk, which was linked to the mortgage side. And so even though it may represent a small proportion of the population, it may represent a larger slice on the balance sheet of the banks. So it would still be a category worth monitoring. But the advice would be to monitor them sequentially. So isolate what is the commercial property side, isolate the SME lending and even the corporate lending, and isolate the mortgage side and see how those patterns play out.
So they should report like that as well, I mean.
Or at least internally. They should monitor like that. It's easier for capital markets if they report that way to make assessments. But internally, the following of the risk patterns for the secured side should follow those three steps. And for the unsecured would be mostly around the evolution of the macroeconomy.
Byron, makes sense to you?
Yeah, I mean, I feel like we're sitting in a bit of a vicious cycle because, we were probably about to hit a big striking season again. And of course, strikes result in wage increases and that'll increase disposable income. But at the same time, that brings down global confidence in South Africa, the rand weakens, and that increase in disposable income is almost cancelled out because all our imports increase. We are sitting in a bit of a tough situation. But I still think the base is still coming off fairly low in terms of South African consumption. We still got a lot of people that are looking to be liberalised and entering the middle class, and we've seen fantastic growth in the retail sector over the last 5 or 6 years, but there's still millions of people out there that are waiting to get an education and to go out and hopefully find jobs. Unfortunately, the private sector aren't creating enough jobs at the moment, but if we start getting policies more adjusted towards business, then obviously we're going to see that coming through.
Yeah. Gary?
It sounds like a long-term plan. I hope can come right. But I mean, I was just looking at some numbers the other day. I mean, if you do, I think a lot of the credit demand that's come through. I mean, you are seeing, if you look at the LSM. I mean, the upper LSM is sort of 9-10 is very stable, and the middle class we can see is growing. I mean, the very low LSMs, that population group is shrinking. But still, if you look at unsecured numbers, I mean, you're probably saying, I think, out of credit extended, I think only 38% of people up to date on payment on unsecured. So that's the vast majority are underwater and in distress. So I mean, this is where this sort of little retail bubble, maybe if you want to call it that, was perhaps financed by the credit. I mean, the consumer, I think, is running out of power to keep it going unless we see structural reform.
And some of those companies that were exposed to that lower LSM, where people pool money, cash build, for example, rural areas, they showed strong growth right through the recession, but they're not now. So it's like the end of that run. Jean, I just want to shift the discussion to, South African banks escaped a lot of the problems in the mid-2000s, partly because of regulation, and a man called Errol Kruger, who was the registrar of banks, the man who saved South Africa, who told them to stop lending. But in the aftermath of that crisis, splitting investment banking from retail banking, new models of banking coming up, and how does our banking sector look in relation to that? Will we be immune from that, or is there going to be pressure to split them? One of our banks, First Rand, of course, has a model where it has already devolved decision-making, accountability, reporting and so on, but the others are very monolithic.
Well, I think that there will be a pattern of repetition after the first mover in terms of regulation moves in one way or another, be it Vickers or any other form of separation. There will be a pressure for other regulators to follow suit. The decision would then be country by country. How far will you go in terms of that separation and what you force in terms of ring fencing? For the growing economies, like South Africa, there will be less pressure, given that growth solves a number of issues in terms of the risks for the banking system, in terms of the impact on society. And so for as long as there is growth and sustained growth, we believe that there will be less pressure from regulators to change business models and to tighten conditions and terms.
Byron, you've been watching this, and do you expect any change for us?
Well, I think, as a potential investor in banks, we sit in that position and we look at the kind of assets that they hold. And the whole investment banking side is something that we're not very keen on. I think there's a bit of a lack of transparency, and with extra regulation coming in, we might see more transparency, but I think those days of abnormal returns and huge trading wins and losses are probably over. I think the retail sector still has quite a long way to go, especially in Africa, and our big four banks are all trying to focus on getting involved in a very underbanked Africa. So there's a lot of potential. And I think the asset management side has also got a lot of growth potential. I mean, you have a look at Investec, and they're really pushing their asset management business. We are seeing this kind of diversification, but again, as a potential investor, I think there's better opportunities out there. And I mean, Warren Buffett often says that he looks at banks enough to know that he doesn't know what's going on, and he just wants to stay away.
I wish more people would be honest about that kind of thing. Just a final comment there, Zhao. It links in with what Byron's been saying. You say there's been growth in the sector, but banks have not grown their profitability.
Well, that's not necessarily a bad thing in the short term. So if you're not growing profitability because you're provisioning and because you're actually keeping your cost of risk under control, that's actually a good thing.
So there are times when you need to do that.
There's a path to grow those profits and a healthy path to do it. So we are bullish.